as I said, 606, and there are 12 students at this point of time. Now, I don't personally care about attendance, because if you know all of the material and decide not to attend, that's absolutely fine. However, I don't think that is actually true, that everybody knows all of the material, but because you are taking the class, you are paying for it, so I will presume that you are here to learn. Given that, uh, that I got the final roster today. There are 22 students in this class. So what I have today is a little over half of you. And I think it is the same people that I see almost on a daily basis. So I'm going to make sure that I make a note of the people that are here today. So I'm going to just call out your names, and you will respond yes, or of course you cannot say no, but yes. And so let me just do the, and of course, as you know, I'm going to allow for another couple of minutes. As you know, I have already sent out the groups, and this time I did not hear back anything, but I also said that this is final. So I have accommodated all the requests that I could, and these groups will not change. Secondly, I've also announced the two dates, June 3 and June 10. June 3 is going to be the review session, which is optional. That means that on request only. And June 10, of course, is the exam. So, and of course, it is, I said it is mandatory, but of course it is. So given the lack of attendance, I am actually feeling more and more inclined to include an individual section in the test, because in a group test, you can pretty much get almost full credit even without attending the classes. And this is going to be open book, not the like end of chapter problems, but given the lack of attendance, I think there should be a component which will allow me to at least directly see whether attendance helps or not. So I'm just going to open the class roster that I've already shared with you with respect to the groups. That's the same one I will be opening, and I will just see. I already know who are here, but still I want to make sure. So as soon as it is on the displayed, I will be. This is not the one. This is the one. So I'll maximize and so that you can all see it, that this is what has been posted. And I hope you can see it. So I'm just going to call out your name, and I'm going to make a record of the date here. Poonam Bharadwaj. I don't think he's here. I just saw Carlos, so I know Carlos is here. Edward?
Yes, sir.
Yeah. Malcolm.
Yes, sir.
I don't. You are here, Malcolm?
Yeah.
Yes.
Yeah.
Reese Gawransky is not here, I know. Oh, hold on. Matthew Donoso?
I'm here.
Oh, good. Okay, thank you. Reese, I don't think is here. I don't think Pitya is here.
Up here.
Oh, good. Sorry about that, Pitya. I'm sorry. Because sometimes
It's
what
fine.
happens is that I don't always remember all the names. Okay, I'll just call the names so that way I will be sure. I'm sorry about that. Tian Liu? No. Julia Laschivio? I'm not possibly saying the name right. Christine Majuro? No. Leah Medina?
Here.
I'm here, Professor. Christine.
Oh, you are Christine.
Yes.
Okay, sorry. And
No, Professor, I'm
Gokul-
here. Leah's here.
Oh, Leah is here too. Okay. And Gokul, I saw him yesterday, but I didn't see him today. Tram Nguyen?
Yes, I'm here.
Good. And Chi Pham? No.
Yes.
Tom is here.
Okay. Alex is here, I know. David Schreier? No. Ping Yu Shao? No. Peter is here.
Present.
Clifford Weed?
Yeah, I'm here.
Okay, good. And then Yuliang Zhu? No. Hangsheng Yan? No. And Ziwan Zhang? Okay, so I'm just going to put this thing on display for a second so that you can see whether I have missed you or not. Okay, Shao is here. All right, Shao. I missed. All right, so in attendance are 4 + 1, 5, 7, 10, and 13. And as you can see, there are 22 students, so a little more than half. So it is what it is, and all of the groups are here. And as I said, I have not decided. Of course, it is going to be a group exam. The bulk of it will be group. But whether I will be including an individual section or individual part or not, I have not decided yet, but I might. And of course, the individual and the group cannot be combined. So there may be a 25% individual take home, or I'm not going to give you an exam twice, a 20 or 25% take home component, and that will be given to you in full trust of your code of honor that you will not exchange any information. And I will be giving you a very, very short window for that. So if there are no more questions about the group.
Professor, I have a question.
Say that again.
Oh, this is Alexei. I have a question, Professor. So let's say we have a teammate and we're unable to reach out to him. Let's say he's not responding to the email that is listed, for example, here on the Excel spreadsheet.
Oh, well, I mean, in that case, you will let me know.
Got it.
Look, I mean, this whole thing is a graduate class, advanced graduate class. So I trust your integrity completely. If somebody is not sharing the load, then it is up to the group to actually inform me, and I will take action accordingly. But if you don't do that, then there is no way I can actually point to somebody and for lack of contribution and penalize him. I'm not going to do that. So unless there is any direct sort of report from the group for lack of participation, or who knows, lack of knowledge or whatever, then yes, the group bears the responsibility for informing me. Now, I as I do with most of the exams, there will be a statement that all the students of the group will have to jointly sign, meaning that the names will be listed there, and you will simply have to say that, yes, we certify that all of the members contributed equitably. And that's the most I can do. And I will be including that statement in the test so that there is a direct responsibility on each one of you to actually make what you consider to be equitable contribution for your membership of the group. That's the best that can be done on a situation like this. Alexis, your hand is still up. Do you have any other question?
No, not anymore. Thank you, Professor.
All right, folks. So now we are fully organized. The groups took a little time because the program, when they first sent me the roster, 4 names were missing from that. I do not know why. I got the final list today, and this is the final list, and all groups have been formed. So I think we are in very good shape. So let me start the class. And as you know, we will be following the basically the roadmap that I laid out. And today we are going to be merger arbitrage. Now, I am a little under the weather today, so I possibly will not have enough stamina for going, let's say, 2.5 hours or so. So we'll see how long I can go. But let me just give you a brief introduction to, and the other thing that I will be telling you is that I will be going through one of the cases in full detail, which is note on risk arbitrage. And I have my slides also, but I will go through the notes, rather the case directly first, and then I will show you my slides. Those slides are all very comprehensive. I have slides on Abbott versus ELSA as well. So I think between the two slides, you will be able to fully follow both cases. However, I may open the slides, but I never read back from my slides. So I'll go through the case, and most of the material in the case is basically in the slides. So the slides are basically what the case reflects. This is the only case, one of the case is, which is a little theoretical in the sense that there is some modeling involved. Now, of course, you will not be required to do any of the modeling, but you may actually be required to actually use one of the in the test. But I will get to that but as it happens with all formulas, as I have told my students all the time, there's always a story in a formula, in the sense that the formula is actually trying to depict a process. So it is most important to understand the process also as to where our model came from. And so long as you understand it, applying the model is not going to be too difficult. So with that introduction, let me start. That what happens in a merger is that there is one party that announces an acquisition of another party. The party that is doing the acquisition is called the acquirer, and the party that becomes then it becomes acquired is called the target. So A and T. And usually what happens is that, and I mean, the cases that we will be looking at where both parties are traded, meaning that there is a stock price for both of them. And there is an offer that is made by the acquirer. That means that if the stock price for the target is $50, the acquirer may say, we are going to take over the company at $65. Now, the $65, as you can tell, is $50 above the current stock price of 50, which means that it's a 30% premium. Usually the premium is around 30 to 40, 50%. So the target shareholders are getting a huge rate of return all of a sudden on their money. Now, as you know, many mergers, not all, often become often attract antitrust regulation and antitrust investigation, which means that there is always some doubt as to whether the merger will take place. That's one of the reasons, which is why there is always some uncertainty with respect to the merger, that it may or may not happen. So usually mergers are announced on Friday night, so that the market has the weekend to actually study and research the merger. Now, if the stock price of the target is $50, and if the acquirer says we are going to offer 65, or let's say 70, let's take a round number, then when the market if that announcement is made on Friday, when the stock price of A, which is the acquirer, is, let's say, 40, and stock price of target, let's say, is 50. And if A says we are going to pay $70 for this target, and when the market opens on Monday, as you can see that the target has already been offered a premium of $20.
I think you forgot to share your screen.
Because there is nothing on the screen to share.
Okay.
I will get to that. Well, since you say so, maybe I can actually share something that I really wanted to. So hold on for
Professor,
a
we
second.
just want to see you. Professor, want to see you because we don't see you, Professor.
What is that?
Your camera is not on, Professor. So you had,
Oh,
so
my camera is not on. Oh, sorry.
yeah. So
Hold on for a second.
Yeah,
we're
once
trying
you
to
once you
say we
start
would like to
recording, it turns
see you
everybody's
sharing your
camera
face.
off.
Hold on. Oh, okay. Good point. All right. Okay. Let me make sure that I have an example that I can share with you.
It looks like you're
Um,
doing the risk arbitrage PPTX.
Yes, but I am going to share an example that is handwritten. So give me just a second. That way, I think the point that I was making, it will be easier to follow. So this is a simple example, and this is also posted, so you can actually look at it. And this is the story I was telling you that Friday at close, the stock prices are 25 and 30, but I was talking about a cash merger. This can be a cash merger of $50, or notice that it can be a share merger, stock for stock merger, where A can say that it will pay 2 shares of A for every share of the target. That means that the target stock price is 30 and A is offering $50. Now, if it is a cash offer, then there is no uncertainty in the sense that, let's say that here is the one of the things that I cannot do with the Dell laptop, which is why I'm trying to change it, is it is very difficult to actually use any pen on the screen to point to something. So that's why I don't like Dells, but they have already given me these. They say, no, we will not be changing it for at least another 2-3 years. Microsoft Surface is the best with respect to teaching online when you are actually teaching from the screen. In any case, let me see if I can actually not underline. So for example, these are the two prices, as you can tell, 25 and 30 and $50 cash offer. Now, on the Monday, when the market opens, A stock is at 22 and T stock, that means the target stock, is at 40. Let me explain the process. That when the merger is announced, the stock price of the target is $30. A offers them $50. However, why is it that when the stock opens, on the trading opens on Monday, target stock does not go to 50, but goes only to 40? There is, I don't know if you can hear it, there is a big storm here, so I hope that I do not lose the internet connection. In any case, did everybody follow? This is a $30 stock when it is announced. And a company says, we are going to offer you $50 when the merger is consummated. Usually, the process for the merger consummation takes about 3 months because they have to go to SEC, they have to go through antitrust and everything. And so, on the following morning, that means Monday, A stock goes to 22. Now, these are numbers I've made up, but there was actually a situation very similar to this, where these numbers that I am using are rounded up, but this stock was possibly at 21.65 or something, I don't remember. But these are actual numbers. And T stock goes to 40. My question to you is, why is it that the T stock did not go to $50? Remember, I'm assuming that the average time it takes for a merger to be consummated is about 3 months. That 3 months later, this merger will be completed. At which point, are either going to get 2 shares of A or $50 cash. If the merger is completed, no matter whether it is 3 months later or 6 months later, Target shareholders, if it is a cash offer, will definitely get $60, $50. Why is it that the market opened at 40?
I think maybe the investors think that the merger doesn't have a perfect synergy, meaning the combined company value will be less than the individual companies, or
So
actually
you are
the
saying
target
that
company.
the target shareholders, target shareholder, when you say market, which market are you talking about? I mean, are you thinking that that A is overpaying for the stock?
I think yes. I think somewhat overpaying.
So A has sort of overvalued target stock.
I think so.
Okay. Let me ask the question. What Peter is saying is definitely possible. That oftentimes the acquirer overvalues the target.
I think
My
it's more
question
likely
to
that
you,
the market.
listen to the question. I'll stop in a second. Listen to my question first. Even if what Peter said is correct, does that matter?
No, because they're going to pay it anyway.
Exactly.
What
That's exactly the point.
what the market is saying is they're not sure that the merger's actually going to go through. There's still a risk associated with the fact that the merger may not happen.
That's exactly right. So Peter,
So,
your point is well taken. But remember, it's like you are buying a house, and if you are overpaying, you are overpaying. Because you have already signed the mortgage, or rather the contract. There's nothing you can. Now, in many cases, you may be able to back out and lose your deposit. However, once you are, and the market has nothing to do with it because it is between these two parties. So even if your point is correct, that is not an explanation as to why the market settled at $40. Because even if the market thinks that it is overpriced, A is under obligation to pay it anyways if the market merger goes through.
Professor.
Yeah.
What if the interest rates rise? If the market conditions are to change?
Well, I mean, if the market conditions change, even then there is nothing you can do unless there is an exit clause. Now, there are many exit clauses, most of which will refer to target's valuation, in the sense that what Peter is saying may be correct, but that has to be stipulated in the contract. You will see that in the Abbott versus Alza case, that yes, let's say if we spend a little more time on Peter's point, that the valuation was done on some information that was false information supplied by the target. And if that false information becomes public, then A has the right to actually exit the contract. Sure. And that uncertainty is always there. However, that will be if there is some falsification of material information. Otherwise, not. But there is no question that for various reasons, the merger may fail. One of which could be the falsification of material information or suppression of material information, or maybe that the state of the economy cannot be an exit clause because nobody knows what the state of the economy will be. Exit clauses are something where the reason for that is attributable to one of the two parties. A state of the economy is not attributable to one of the two parties, but a false information is. Or you will see in the Abbott versus Alza case that particularly when it is the merger depends on the valuation of the acquirer, if the acquirer has suppressed some material. In the Abbott versus Alza case, Abbott, as I recall, these are drug companies, had some, federal investigation with respect to one of the drugs that was under test at that point of time. And the outcome of that could be the reason for either of the two parties to actually exit the contract. But if those things do not happen, and if the merger goes through, even if A is grossly overpaying, the value that target shareholders will receive is no doubt. So wrong valuation of the target is not a reason for the discount, and the discount is pretty substantial, 50 to 40, and the entire discount is for two reasons. One, Cliff has already pointed it out, is the uncertainty with respect to whether the merger will be completed or not. The higher the uncertainty as to the completion of the merger, the larger will be the discount.
Sorry, I have to correct myself. Actually the acquirer's value will drop in case of the synergy is not really perfect.
Of course, yeah, because the acquirer values almost always drop anyways because of the similar reason that you are talking about, that their market always suspects that there may have been some, as you can see that they're here, the actual number was 2165. It has dropped from 25 to let's say 22, which is $3 on $25, roughly about 12% drop. But that I don't think has anything to do with the target price being at a discount from the offer price. The main reason there is the uncertainty as to whether the merger will be completed. And there is something else also, which has been pointed out, that is the risk-free rate or the market interest rate. Why? Because you are not going to get it right now. You are going to get it 3 months later. So there is a little bit of that, but that's not really a very large component. That cannot be anywhere near $10. So when it's a cash offer, particularly a cash offer, the main uncertainty is with respect to the completion of the merger.
Yeah, Professor,
Yeah.
is that not what we refer to as like there will definitely be a problem in terms of the dilution of the shares into the acquirer?
Dilution of the shares of the acquirer, I am not following that.
No, what I'm saying is that the targets, you said why the value of the target didn't go up as anticipated.
Yes.
Is that not the question?
The question is, why is it that the target sells day after the merger is announced? Why is it that the target price settles at a discount from the offer price? That the offer price is 50. Why is the target price settling at 40? The actual price was 39 something. I rounded it to 40. But remember that one of the reasons, of course, is the time value of money, but that cannot be $10. So the only question I asked is, what explains the fact that the target is selling at a discount? Now,
A lot
one
of
of the other
uncertainties into the completion, as you said.
say that again, Edward.
I said there are a lot of uncertainties to the completion of the acquisition, like as you said.
Yes, but the main uncertainty is with respect to the completion of the merger. And as you are right, there can be a lot of different reasons for it. And you might wonder, why is it that the mergers always get announced on a Friday evening? Almost always. The reason is that the market needs to actually study these uncertainties. And there is a mad scramble going on where the arbitrageurs will start calling their friends and all that. And the only thing they want to know is, what do you think? Is the merger going to be completed? That's it. That's all they want to know. So there is a lot of research that goes on. Now, of course, the valuation is definitely an issue, which is what Peter said. I'm not suggesting that the valuation of the target is not an issue. However, that valuation is an issue only if the target has basically falsified any material information. And if that news comes out, then it will definitely affect the valuation, and the acquirer will have the right to pull out of the contract or the offer if there is any falsification of material information on behalf of the target. The same thing with respect to the acquirer also. Let me ask you, does the acquirer valuation matter in a cash offer? Even if the acquirer has falsified any information, does that matter in a cash offer?
Well, the falsification could have an effect in the contract itself, but otherwise, no.
No, it's a cash offer.
It's a car because the cash is paid immediately.
So cash offers are easy. They're not that common. They're definitely becoming increasingly rare. The most prevalent is the stock for stock swap. But there can be a combination of cash and stock. So for a cash offer, the only uncertainty is the completion of the merger. But is that the case when it is a stock for stock? For example, in this particular case, you can see that yes, the target is roughly at a 20% discount. So if you buy the target stock, then you are going to get $10.40, which is almost 25% rate of return. One of the things that I should point out to you is that the pre-announcement prices do not matter, because you cannot actually trade on pre-announcement prices. You can only trade at post-announcement prices. Because if let's say that you buy 10,000 shares of target stock T before market closes on Friday, you will definitely be investigated. There is no doubt that whether you had actually traded or insider trading. You know that the president is facing a lot of flack now because a lot of trades that he made, he followed up with, people telling people that go buy that stock. You can't do that. I don't think it will come to anything at all, but there are people who are already complaining about it, that there is a lot of trades that he made in the last month or so where there was subsequently some movements in the stock that he talked about. You can't do that. Anyway, so this is the case where if you trade on pre-announcement price, then you will be investigated if it is a very large trade. One guy that used to do that as a matter of profession, the name is Ivan Boesky. You have not heard him because it is before your time, but you can check him out on the Google. Ivan, Ivan Boesky, Boesky. I don't know if he's still living, but I think it was in the late 80s that he used to actually trade on insider information only. So he had a lot of huge network. So he would be calling all his friends and all that, and will trade on quasi rumors. Rumors meaning that he would work on the rumor and will have an insider actually confirm it, and then he will start buying the stock over the weekend. And he did that successfully for a number of years. After which he got caught, and I think he went into prison for the rest of his life. Now, so it's a very easy thing on a cash offer to actually capitalize on that arbitrage of $10. So if you are facing this cash offer where A offers to pay T $50, and on Monday the market opens for T at 40, what would be the easiest way to actually exploit that arbitrage? Buy T stock at 40, right?
Yeah.
Remember, you cannot buy at 30 because that is already gone. So the best you can do is wait for the announcement. And as soon as the announcement is made, wait for market to open on Monday. You buy at 40. If the merger is consummated, you get your $10.
But sorry, how can you buy for 40 if it's announcement after Friday closing?
You gotta
No,
wait till Monday
Friday-
morning.
Monday, you're
Monday.
right, Monday morning. Monday is the opening price on Monday is $40. The
Want the
price cannot
market
move
right
on
away?
Friday. Price cannot move on Friday because you made the announcement after the market closes.
Yeah, but Monday morning, won't the market right away adjust to almost 50?
No, that's the whole point. That's what we have been discussing.
So then, Professor,
Because
why
the
is it
market-
that
Yes.
so why is it that major arbitrages still exist, even if the market is efficient?
That's a very good question because, see, even if the market is efficient, you cannot actually rule out the possibility that the merger will fail. That's what the arbitrators are actually taking advantage of. That there is a finite probability, and many mergers fail. That there is a finite probability that the merger will fail. And if you are 100% certain that the merger will happen, then the stock price will settle to not quite $50, but the present value of $50 over the next 3 months. That's it, which may be $49 or so.
I don't know if you're going to talk about it, but you have it listed there. The Sprint and Spirit Airlines. That was the
Yes.
government saying that they couldn't do it.
Yes.
And the government was the exact reason why they couldn't.
Mhm. Well, that's why I actually picked up the story and posted it so that you can see how actual mergers work. Yes, I may not have time to talk about it. In fact, Cliff, that was the case I gave the class last year.
Yeah, and that's why Spirit is bankrupt now because Elizabeth
Exactly.
Warren wouldn't let it merge.
Yeah. So let me repeat that people have been asking. Now, I think some very good questions have been asked. Well, over the last questions, now one question was Peter's, that there is uncertainty about that company A may have actually overvalued company T. And what I told you is that does not really matter because you are under obligation to pay $50, no matter whether you made a mistake or not. Your shareholders may be very upset, but that does not matter. But to Peter's point, if that is the case, if the shareholders feel that they have overpriced, then a stock will suffer. But also remember that many of these actually have to require shareholder approval. Now, a cash offer may not, but a stock offer always will. But to come back to the point again, this is not an indication of market inefficiency. Let me explain to you why. Because market efficiency requires only one thing, and that is that all of the public information is reflected in the price. So I don't remember who raised this question about the inefficiency. Let me stop at this point of time and go back to the class. Who asked the question about inefficiency? Let me go back to that person. That why is it that this is not necessarily a reflection of market inefficiency? Because market inefficiency will mean that some information is not reflected in the target stock price. What is that? What are you saying is a piece of material information that may not have been included in the target price? That is possible only if target has deliberately suppressed some material information or falsified it. Remember, if that is the case, then the merger is going to fail anyways because A is going to pull out. A will say that we are going to exit this merger because this whole deal was made on certain assumptions that are now violated because A falsified, rather the target falsified. So I don't see where you see the question of lack of market efficiency here. Was that you, Malcolm?
Yes, that was me who asked that question, sir.
Do you understand why that may not be a concern?
Yeah.
So these are good questions because by discussion we can rule out these possibilities. So no, for wrong valuation by A is not a reason for the discount. Market inefficiency is not a reason for the discount. The reason for the discount is simply the uncertainty surrounding the completion of the margin. That's it. When there is a cash offer. Now let's go back to that thing again, and let's take a look at this once more and see what happens in a stock for stock swap. When A says that we are going to pay you 2 shares of A for every share of T, is the completion of the merger the only source of uncertainty?
No,
What is the other one?
the price of A stock and T stock will move with the information of the merger.
The most important one, Cliff, is the price of A stock. Because you are going to get 2 shares of A. So you don't know what the price of A shares will be on the day the merger is completed. So you are completely exposed to the valuation of A. And again, if A has falsified, then yeah, you might lose. So in a cash offer, the only source of uncertainty is the completion of the merger. In a stock offer, in addition to that, there is also the uncertainty of what will be the value of A on the day the merger is completed. Now notice that you are buying at 40. So if the stock price of A, for some reason, on the day of the merger is completed, falls below 20, you are actually going to lose money. Because you're not receiving $50. So in a cash offer, A will say, we'll offer you 50. In a stock offer, they will not say that. They will not tell you a price. They'll tell you the exchange rate. And the exchange rate is 2:1. That's it. And that 2:1, the exchange ratio, brings in additional uncertainty with respect to movements in the stock price of A. So in a stock offer, the value that you are expecting is not 50. Forget about the 50 in a stock offer, because all you know on Monday morning is that I am going to get 2 shares of A at 22. If the stock price ends up at 22 on that day, then you are going to get $44, for which you are paying $40 now. That means your rate of return is $4 on 40, 10%. Not bad for 3 months, but not $50. Also remember that Friday's prices do not matter. So you are not trading on any information that is not known to everybody. It's known to everybody. So you might think that why doesn't everybody get involved in the merger arbitrage? So in a cash offer, you will simply buy the target stock at 40 and hope that the merger goes through, so you get $10. In a stock offer, you will buy the target stock again at 40, but you are not going to be expecting $50. You're going to be expecting 44. But the number 50 is not relevant there at all because A has not told you anything about 50 at all. All A said is that a stock for every share of the target. So your rate of return is going to be 10%. Now, I'm not saying that is the maximum or the minimum. I am saying that is the expected rate of return as of the time when you actually entered the trade. So in a cash offer, the only uncertainty is whether the merger will be completed. On a stock offer, you have that one, risk with respect to the completion of the merger. You also have the downside risk on the price of the acquirer stock. That what if the stock price goes down?
You could actually lose money.
Well, of course you could, definitely. You are not losing money as of the time you enter the contract, because as of that point of time, you are good, $10. I'm sorry, $4. Yes, $4.40, so 10%. You are good. If it stays that way, then you are fine. You don't know if it will or not. So let me ask you the following question. When you know that there is some potential and real potential that the stock price of A may drop, which will mean that I may lose in net terms when the merger is completed. What can you do to actually minimize the loss from the potential downside of a stock?
Buy a put.
What position do you take when you are trying to protect yourself from the downside of a stock price movement?
You buy a
You
put
should
and
have
that.
a stock.
One option is buy put, of course. But remember, always remember, a long put is an insurance contract, which is going to eat into my rate of return. It's not free. No protection is ever free, period. I am not saying that's the wrong answer. In fact, that is the right answer. And that's one of the things that the arbitrager is considering in this particular case. But think of a more fundamental thing, that I am looking at a situation here where I am buying the stock and there is the risk that the stock price may drop. When you are concerned that a particular stock price may drop, now remember, you're not buying A, you are buying T. But your problem is that what you get in terms of the cash depends on the A stock, where you have some downside risk. If you want the downside risk to work in your favor, what position should you take in A? Let me repeat the whole process again. Position with a cash offer is very clear. Just buy the target stock, period. Position in a cash or the stock offer is a little more complicated, because just buying the target may not be enough. Why? Because you don't know the price. You don't know the cash flow. The cash flow depends on the value of another stock, which is A. So if the A stock goes down, you are going to lose on your position in the target because you are going to get less money.
Well, the other thing you could do is sell a call.
Okay, that's good. That's good. You could do that. Or Cliff, another way would be to sell or short sell A. So that transaction in a stock offer would be buy the target and sell the acquirer. Why? Because now let me explain. If you buy the target and sell the acquirer, you might think, well, wait a moment. I'm selling a stock, and if the stock price goes up, I'm going to get more on the target side, but I'm going to lose on my short side. Yes, of course. But if the stock price of A goes down, then you are going to get less on the target, but you will be compensated or by your gains on the short side of A.
Yeah, your way is just going to lock you into a profit range.
Exactly. That's exactly the point.
Maybe you win 10%, maybe you max off at 15%,
See,
somewhere in that middle.
if you do the following, and we will show that mathematically when we get to the case, I'm just going to give you the intuition that if you buy the target, if you are long the target and short the acquirer, then if the only the interesting thing here is that the final value for what you are going to get on the target stock depends on the acquirer stock. So if the acquirer stock goes up, then you are going to get more on the target side, but you are going to lose on the acquirer side because you sold it short. Fine. But for that loss, you will be compensated if the acquirer stock price goes down. If the acquirer stock price goes down, you are going to lose on the target side, but you are going to make some money on the acquirer side because it is short. And it can be shown mathematically that if you do this, then no matter what the stock price of A is, you will be locked into a profit. It can be shown. So all stock for stock transactions are always long on the acquirer, long on the target, short on the acquirer. That additional transaction, the short on the acquirer, you need not do when you are in a cash transaction. That's the theory of this whole thing.
Yes, Professor.
Yes.
In a share merger, most often we find out that is the acquirer's share price often is higher than the target.
I am not sure about that.
Okay. Let's say in one scenario, the acquirer's share price is higher than that of the target. And then at the end of the day, they agree a share ratio. Let's say if it is 1 share of the acquirer and the 2 shares of the target for 1 share of the acquirer, that automatically, is it not one of the reasons that will lead to the increase in the price of the target?
Hold on. The ratio is not 2 shares of the target. The ratio is always how many shares of the acquirer. So that's how you need to think, that the target is always 1. The question is how many of the acquirer the target shareholders are going to get for 1 share of the target. That's the way the exchange ratio is always expressed.
So based on that, tends to depress the price of the acquirer. Am I correct?
Yes.
And then appreciate the price of the target.
Yes.
Okay. So in that situation, you're asking, is there any room for arbitrage to make money on the acquisition, on those margins?
Of course. Let me take an example of what you are. I'm just making it up. Let's say that you have a target at $50. Okay.
Yes.
And let's say that you have an acquirer at $80.
Yes.
Or if you want it the other way around, we can do that. But let's look at 80 and 50. So the acquirer came in and said, well, we'll give you, let's say, 0.8 shares of A for every share of the target. Okay, that means 80 times 0.8 is around $64. So for a $50 stock, you are going to get $64, which is $14 gain on a $50 stock, which is roughly about 28%, 28, 29, 30. It is always between 20, 25 to about 35. That's the range. However, that announcement will be made after the market closes on Friday. So as soon as the announcement is made that this merger has been announced, the prices, the closing prices of Friday do not matter anymore because you cannot trade. The market has already closed. So that's when the scramble starts. That, hey, I see that if these prices prevail, which it will not, that 0.8 shares of A. So the question that will be asked are twofold. One, what is the price at which the market will open on Friday, on Monday? So you know that when the market closed on Friday, it was $50 closing price, $64 was the offer price. However, that doesn't really matter because on the following day, on Monday, let's say that the acquirer actually opened at 75. Then 75 times 0.8 becomes the offer price. And target, of course, will jump as well. And it is that change in price that will determine how much is the arbitrage. And so when they are actually speculating on Friday, they don't know at what price the market will open. And that's fine because they're not trading. You cannot trade. So they are ready that we will be trading on Monday, but they are waiting for the prices to open. And you will see that it is the theory, you can actually know once you see the opening prices on Monday, which are the prices only the prices at which you can actually trade, you can actually work out a probability that this is the probability that the merger has to succeed for me to make any money at all. And that probability is called the zero money probability or neutral probability. We will calculate that if the probability of the merger is above this, then we are going to make money. If the probability of the merger going through is below this, we are going to lose.
Is there any way to calculate this probability, or other question is like
yes, that is the theory that we will be looking into. Yes.
Is there also a practical? Is there also a practical way, in practice, like looking like what's the website? This bidding website? I forgot. Yes. Was that what? Kalshi, and was the other one? Polymarket is even bigger. So, is that a good strategy as an indicator to using them?
That I cannot answer. I don't have the experience. I never do this because in order for you to make money on this market, you have to move millions of dollars. Hedge funds do that. Petty. No. I mean, I can do this, but I'm not going to make anywhere near as much money as these people will.
No, what I mean,
the amount
like
of money. I'm sorry. Go ahead.
What I mean, just using as an indicator example, like in these situations, like mergers and acquisitions, or like in kind of like upcoming quarterly earnings and announcements, and kind of predicting what the outcome could be. Is that a good practice, or really like just a gambling?
The question is not whether it is a good practice or not. The question is that once you determine the probability, and I will show you from the theory that probability can be easily calculated, it is your call. I mean, let's say that the numbers, that opening numbers on Monday tell you that in order for you to make the assumption is that on a cash offer you are buying the target, and on a stock offer the assumption is that you are buying the target and selling the acquirer. If you were to do this thing, then here is the probability on Monday's opening prices that if the probability associated with the merger, in your estimation, is below this number, don't go for that. So it's a matter of your own assessment of the probability that the merger will go through. And that's what these traders are trying to do over the weekend, calling their friends. This is a very, very high profile group of people that do that because of the amount of money involved here. Hundreds of millions of dollars will move instantly. And also, Peter, to your question, remember one thing, and we will see that in the Abbott versus Alza case, that as you can understand, that on a cash offer, of course, during the 3 months, the prices of the acquirer and the target will fluctuate. That doesn't matter. It has no bearing on the success of the margin. However, on a stock for stock offer, the spread and the acquirer, meaning that spread is basically the arbitrage you are actually trying to exploit, will constantly fluctuate. And that's what makes it so risky. So this case, yeah.
So, Professor, on that, so at what stage does for a stock-to-stock merger does the prices become dominated by the completion of probability rather than its valuation, the valuation of the exchange ratio?
No, I wouldn't put it that way, because you know that there are two things can happen. Prices will fluctuate. There's no question about it. But the source of the fluctuation of the prices is what is important to us. If the source is, somebody said at the beginning of the class that the economy might be the reason. If the economy is the reason, then there is nothing that either of the two parties can do. And that fluctuation is okay, because it will move both prices equally. However, if the source of the fluctuation is because of some suppression of some material information or falsification, then it becomes a serious issue. Because remember that movement in the acquirer price and target price will constantly move the spread that you are targeting to make. However, if you go long on the target, one share of target, and short on the acquirer, but you cannot go one because there is an exchange rate. If you go, let's say that in the particular case that we will be discussing about versus Alza, the exchange rate was 1.2 shares of A. If you short 1.2 shares of A for every share of target that you buy, you should be okay. Unless the spread becomes too wide. And that's when they panic. A lot of questions have been asked. Let me take a look at the theory now. And I'm going to, sorry.
That's my thunderstorm now.
Huh?
That's my thunderstorm now.
Okay, so you see this note on risk arbitrage. One of the things that I should point out to you, this is a situation where the arbitrage opportunity arises because of the risk. If there was no uncertainty with respect to the merger completion, you won't have this arbitrage opportunity at all. Going back to the example that we were looking at, if it is a cash offer, let's say that you offered $50 and there is no uncertainty about the completion of the merger, then on the Monday morning, the stock price of T should be the present value of $50. That's it. That no, there is no uncertainty about it. But if there is some uncertainty, then the discount will be higher than the difference because of the time value of money, and that difference is what you are trying to exploit. That's it. So remember, the opportunity arises because there is risk involved. So this is one situation where you are not trying to minimize. So the higher the risk and the uncertainty with respect to the merger, the higher is the potential arbitrage profit here. So let's take a look. Says in the introduction, in its simplest form, risk arbitrage involves buying the common stock of the target company, the cash offer, and selling short. Of course, I'm sorry. This is not the cash offer. This is stock offer. Selling short the stock of the acquiring company. The acquiring company in an acquisition. The acquiring company in an acquisition or the surviving company in a merger is referred to as the acquiring company, and the company being acquired is a target company. We don't need to pay attention to any of this. The important thing here is that typically the target company stock trades at a discount to the value of the acquisition offer, and that discount is what the arbitrageurs are trying to capture. And as I said, all we are asking is what is the reason for that discount in a cash offer? It is basically the time value of money and the uncertainty of the merger. In a stock offer, it is the time value of money, uncertainty about the merger, and also uncertainty about the acquisition price. Three things. So it says, how do you actually go about arbitrage? These are the questions. What is the spread? That's all they really are trying to capture. What is the spread between price paid, meaning offer price, and the closing price at of the security on deal completion? How likely is it that the promised event will indeed occur? This is the biggest question. How long will your money be tied up? Usually about 3 to 6 months, unless there is a prolonged, antitrust situation going on. What are the odds of a better bid being received before the event is finalized? This is an additional source of risk, because multiple bids may come in, and if multiple bids come in, then all the bet is off. And of course, that could be an exit clause built into the contract that if there is another bid, then the deal is off. What will happen if the event does not take place? Very good question. Is there sufficient amount of M&A activity in the market? Because if there is not enough M&A activity, then all the attention will be on the one that you are tracking, and that's not good news. What kind of an M&A deal is the particular transaction that is hostile, friendly, etc.? Friendly deals always succeed, almost always succeed. Hostile deals do not. Now, first definition is the gross spread. Gross spread is value to be received in the transaction, which in our case that we were talking about is $50 minus the stock price of the target, which was $40. So $10 is the gross spread. You should all have this case because this was included in the package. Then the net spread and all that, if it's the same, adjusting for the dividends. Why are we adjusting for the dividends? Because if you buy the target stock, you are going to get the dividends for the target company. And then the potential ROI is the net spread divided by the total capital probability. So there are two possible outcomes. One is the deal completed, which is the probability of P1. And the other one is the deal breaks. There are only two possibilities, one minus P1. So what is your rate of return? Sorry about that. I am just going to sorry. I'm sure this was a spam call. Anyway, so I'm sure you get your own share of spam calls all the time. P1 is the probability that the deal will be completed. 1 minus P1 is the probability that the deal will not be completed. So if the deal is completed, EP is your expected profit. That's what will be calculated. That we can calculate that. And if the EL is the expected loss if the deal is not completed. So your net payoff is P1 times expected, the expected value. So the expected value or expected dollar receipt from the transaction is P1 times EP plus P2, which is 1 minus P1 times EL, divided by how much have you invested, because we have calculated rate of return, times 365 over T. Basically, that is annualization. So this is the model. And notice that in order for you to calculate P1, you need to know E1 and you need to know EP and EL. So in the next few minutes, we will calculate the EP and EL for first cash transaction, then stock transaction, then a combination of cash and stock transaction. But I want to make sure that everybody follows this equation. I is the amount that you have invested. So obviously in a cash offer, the amount of investment is basically the target stock price because you are buying the target. And remember, but on a cash offer, you are buying the target and selling the acquirer. So your investment is going to be significantly less because on one side you are buying, the other side you are selling. So the investment is going to be significantly less. Now they are saying that arbitrageurs find a probability that would make the expected rate of return 0. Why? Because that way, when we calculate the P1, we can say that at this deal completion probability, I'm not going to make any money. So for me to make any money, the probability of the deal completion must exceed this number. So the minimum probability for success or completion of the merger must be P1 for me to make any money at all. And on Monday morning, when the arbitrator is looking at the two prices, acquirer and the target, he can easily calculate this. And I will show you how. So, and they have basically they have substituted 0 here and some algebra. So this equation here is the important one. That the probability is called even money probability, because meaning that you are not going to make any money, you are not going to lose any, you are not going to make any either. That's why it's called the neutral or the even money probability. That is equal to EL, expected loss, divided by expected loss minus expected profit. So let's look at an example. Consider company A, acquirer is purchasing company T in a friendly cash tender offer, very simple, of $50 per share in cash. Company T has public common stock trading at $25 pre-announcement. I said pre-announcement price does not matter, but you will see how it does. Pre-announcement and made up to $40 post-announcement. Exactly the same numbers that we worked with. If the arbitrator buys the stock at 40, he has to because he cannot buy at 30. There would be a $10 upside if the deal completes, but a downside risk of 15 if the deal breaks. This is an assumption. Why? Because what they are saying is that the price went up because of the merger. Now, if the deal breaks, then they are assuming that the target stock price will come back to the pre-announcement price. We don't know that. So remember that the probability that I'm calculating is actually inexact. It's not precise because we are assuming that the target stock price will come back to the pre-announcement value. That's not necessarily certain at all. That's an assumption. So the probability that we will be calculating is actually imprecise. So deal will close in 1 month. Dividend, these dividends and transaction costs basically just overcomplicate the matter. I mean, but this is real life. So 10 cents per share, and interest on cash deposit is 6% per annum, and transaction cost is 30 cents per share. So gross spread is 50 minus 40, 10. Now they have said that, okay, here is $10, here is the negative 15. This, as I said, is the assumption here. The underlying assumption is that the stock price of T will come back to 25. It may or it may not. And transaction cost to buy is 30 cents. So that's negative. Then dividend on, you're going to get $10 dividends. So net spread is 980. Here, the net spread is 1480. So this is your E1, I'm sorry, EP, and this is your EL. So the P1 is 0.60 or 60%. So probability of deal occurrence is 60%. So on Monday, when you look at this price, you know that in order for you to make any money, if you buy the target, the probability that the merger will complete must be higher than 60%. And they have calculated your rates of return for various probabilities here. I'm not going to go through that, but it can be shown that if the probability is 7, you will have 73% return. Okay, so it is all a matter of the probability. And if the merger goes through, then you are going to make the entire money. So it's about 300% return. Now we are trying to calculate or estimate the rate of return, and the rate of return is, remember this was, I think 10 or no, 9.80, 24.5% is, which one is that? I think it is the 9.4080 over 40. So let's see where that is calculated. I'm pretty sure that's what it is. 9.80 over 40. That times the 365 over 30 annualization, 298%. You see that 298% right here. 300% return if the deal goes through. Huge return. But the key is this probability here, the 60%. Now, one of the questions, I believe it was Peter, who asked, can this probability calculated? Can it be calculated? And I told him that yes, looking at the Monday's prices, you can easily calculate those. Peter, is that clear to you?
More or less, yes. Thank you.
Because remember that the only thing I have used in this particular calculation is the opening prices on Monday. That's it. Nothing else. And why did I use the opening prices on Monday and not on Friday? Because I cannot trade on Friday. So those prices really does not matter, excepting for that assumption that the target price will go back to the Friday's price if the deal falls. Now let's look at, yeah, any question? Okay. Now let's look at the stock market. So for example, consider company A announces the acquisition of company T, and what they're saying, for an all stock deal, and offers 1.5 share for every share of T. The deal is expected to close in 1 month, 30 days. Company A trades at 30 per share, and company T trades for $20 per share pre-announcement. Upon announcement, the acquirer's shares drop to 25 from 30, and the target shares increase to 30. So what is the basically the even money probability? Now notice that the value of the deal is 1.5 shares of A at $25, $37.50. Now this is neither the maximum, nor the minimum, nor the expected. Nothing. This is the amount of money you are going to receive as of that point of time. That's it. That when you are entering the trade, this is how much target shares are worth. 1.5 shares A is worth about $37.50. That's what you are going to get, period. What you will get when the merger is actually finally consummated is unknown. So arbitrageurs could buy company T shares at 30 and obtain a profit of $37.50 if the deal completes. However, if the price of A declines from $25 per share to $20 per share, the arbitrager would get only $30, and they have paid $30, so they are not going to make any money at all. Per share, the deal value declines to 30 from $37.50 to $30. If the price of A declines below $20 per share, the arbitrager starts to lose money on this deal since the deal value is below $30, lower than the price paid for each share of T. So it's all dependent on the stock price of A. And there is huge downside to the stock price of A. And I asked that anytime you want to actually make money from a position where the stock price may drop, the best way to do that would be to actually short the stock. So you will short one of them, the acquirer, and you will buy the target. So arbitrageurs commonly short the shares of the acquiring company stock to hedge their purchase of target company stocks. In the above example, the arbitrageurs buys a share of T at $30 per share and sell 1.5 shares of A. This is critical. That you must sell the A shares in the exchange ratio. Otherwise, the arbitrage will not work. So it always has to be in the exchange ratio. So deal price is 1.5 times 25, $37.50. Gross spread is $37.50 minus $30 you paid, $7.50. So if the deal goes through, you are going to make $7.50. So that must be your EP. Now let's look at EL. If the price of A, now remember, as I told you, that if you have actually shorted A, then no matter what the price of A is, when the deal goes through, you will still make the arbitrage profit. And that's what this is trying to show. So when it goes to A 20, says price of A drops to 20, deal price drops to $30, 20 times 1.5, and the price decreases, the deal decreases by $7.50. However, the arbitrage's gross spread retains at $7.50 each. So let's look at the long one share of T. So the deal closing, one share of T is worth 1.5. Remember, $20 is the share of A, so about 30. Loss on the long position of T is 0 because you made 30, you paid 30. Then you are shorted 1.5 shares of A. So if deal closes, shares of A trade at $20. And you make gain on the short is that you sold it at 25, you're buying it back at 27.5. That's the whole point. That if you lock in by longing the T share and shorting A, you will always get $7.50, no matter what happens to the price of it. But there is one catch here. That is that this example assumes that the deal will be or has been completed. If not, it could be devastating. Let's look at that now. So as long as the arbitrator hedges his long position purchase of T's shares by shorting the exact amount of underlying shares that would be received when the transaction is completed, the gross spread will not be affected. However, now the real risk. What happens if the deal actually does not go through? That's the real source of risk here. However, if the deal breaks, now this is where they will assume that if the deal breaks, the shares will come back to their pre-announcement price. Always remember that if the deal breaks, bring all the numbers back to the pre-announcement, which is imprecise. You don't know whether they will come back to the pre-announcement price, but you make that assumption so that the analysis is simplified. Because if you don't know the prices, then there is nothing you can do. So it is best to assume that they will come back to the pre-announcement price. So hedges long position, shares exact amount of underlying that will be received when the gross spread will not be affected. So let's look at if the deal breaks, its shares trade back to 30 and T's shares trade back to $20 per share. The arbitrator loses money. Let's see by how much. The downside risk can be calculated. This long one share of T is $20, so you're losing $10 on each one of them. Now you remember you shorted a stock, so you're going to make some money on it. So 1.5 shares were sorted, and they went from $25 to $20. So 5 times 1.5 is 7.50. Here is 10. So you make 10 minus 7.50, $17.50 you are losing. This is your expected loss if the deal fails. Or, as in the case, the spread has widened so much, you pull out of the deal. Then you are going to lose very heavily. So here is the 7.50 and 17.50 is the potential loss. I'm not going to go through all of these dividends and all that, but let's focus on the number. Net 6.65 is the gain. Net 18.35 is the loss. So this is EP, this is EL. 73% is the required even money probability for the deal to be successful. That's pretty high. So my question to the class is, do you want that even money probability to be high or low? For you to be feeling safe, do you want the even money probability to be high or low?
If we want to make safe or we want to make money, Professor?
Huh?
If we want to feel safe, we want probability of deal happening high. But if we want to make money, I think it can be low. The probability has to be low. That's because it's all priced into the risk, right?
So you are saying that the probability that the deal has to go through will be lower for you to make money. I'm not going to answer that question because this is a 50-50 question. All I'm saying is that you have calculated that 73% is the required probability for deal completion for me to make any money, according to the numbers on Monday. Now, I think that was Alexei. So let me ask you, Alexei, if your calculation is that, no, I think that with 50% chance, even if the chance is 50%, in your opinion, that the deal is actually more uncertain, would you actually buy the target and sell the acquirer? Meaning that if in your opinion the neutral probability was lower than 73%, would you buy it and sell it?
I personally wouldn't, but it depends on the risk appetite, right?
Well, I mean, it depends on the risk appetite in the sense that if you do not have a risk appetite, you're not going to get into this game at all.
So
If
I
you
wouldn't.
if,
you will just
if you think the
you will
probability is
definitely
going to be
want,
lower, you just reverse the trade.
yeah, you
That's
will just
exactly
want
what they. Yeah, sorry.
the
Didn't think
completion
about
of the
it.
deal.
Good call.
Well, I think that was Cliff. That is what the arbitrator is actually thinking, because you will see at the end of the case that the spread has widened. So he's thinking that he has three choices. One is that do nothing. And number two, there is an echo here. Somebody has to shut off the mic. Ear. So number two is that, of course, number one is do nothing. Number two is reverse the position. Take the loss and get out. There is a number three, that is expand your position. So what I really have to say in this case is which is the best strategy for him. Now, I did not actually finish the question as to which direction do you want the even money probability to go for you to make more money, because that's something the class has to think about.
Professor, that is the reason why. Hello?
Yeah.
That is the reason why I'm saying.
Hold on for a second.
Okay.
I want the class to remember what Alexei said, that you want the event money probability to be low. So anyway, go ahead, Edward.
Yeah, that is what I want to comment on. You know, as an arbitrage, if you want to make money, you want the deal to be completed.
Hello?
Because say, for example, like as you said, when the markets open, after the announcement of the deal on Friday, and upon the market opening on Monday, the price of the target rose up to like $40. But what was offered by the acquirer, say, was $50. But it's upon the completion of the deal, we are anticipating that the price of the target will go to like around $50. So there is more room for
that is
you
not
as
an anticipation. Edward,
yes,
that is
a
anticipation. That is a certainty.
okay. That is certain. So if it is certain, then I would definitely want my probability to increase in order for me to make money.
I'm not disputing anything you are saying. I'm saying
Yes.
that I got two possible answers, which is exactly why I said that it is a 50-50 probability. 50-50 choice.
In the
Now,
event if the
let me ask
probability is
you.
low.
Okay,
Hold on. Go ahead. Yeah, go ahead.
The 73% that we calculated was actually for the stock for stock, right?
Yeah.
So what it is saying is that the probability that the deal must be completed is 73% for me to make any money given Monday's price. Any number below that, and I'm going to lose. I am trying to explain to you Alexis's thoughts. So repeat, 73% is the minimum probability for the completion for me to make any money given the prices on Monday. And Alexis said, I want that number to be lower. So the question is his intuition correct? Do you think of it this way, that would anyone touch that deal if that probability required, this is the required probability, was 1, would anyone touch it? No. No.
I think Cliff,
So-
probably a good point. Probably the worst case scenario when it's like 50-50, when it's a 50% chance, because then you can't, shorten it or buy, like, for example, hold and buy or short the stock.
See, here is what you can actually try. That here, remember that
Straddle. You can straddle.
The probability determines the probability that the market's perception of the probability of success of the merger is what will affect the price at which the target opens. If the market's probability is of the merger succeeding is high, then that means that the market expects that that deal is going to go through. You know that the target will be opening at a higher price, and you can tinker the target price to see what probabilities you are coming up with. Now, going back to the case once more. So and notice that the probabilities that the probabilities are worked and the rates of return are worked out. Now, how they work it out, you may try it. I'm going to show that to you next class. That how, let's say, for example, if the probability is 50%, then you are likely to lose money. But it has to be thought of in this particular way, that the required probability is 73%. However, that means that anything below 73%, you are going to lose money. So if the required probability is 73%, then obviously if your perception is that no, it is not more than 50, then yes, you are going to lose money. Of course, because you need 73% probability. On the other hand, that if it is more than that, that means that if your perception is that the deal is more likely to go through, then yes, you will make money. It is all a risk game. Throughout this program, you have heard that risk is something that should be avoided. No,
Managed.
I don't think that is the way it should be considered at all. The basic message of this program is that risk is something that you need to manage, not avoid. Because the best way to avoid the risk, as you know, is to basically buy insurance, buy a put. And when the student fund managers were given that choice, they chose not to do so because it's costly. So this number here, the 73%, is the key number. I'm not going to go through the rate of return because I think you can easily calculate it. The cash stock deal is a little more complicated. And I am going to come back after break and explain that to you. Then we will briefly discuss the Abbott versus Alza, and that will be all for the class. This is very fascinating material, and you can easily do it with 100 shares. But with 100 shares, there is not going to be much. The rate of return will be the same, but the dollars are not. So the people that are actually doing this thing are very, very large hedge funds. Some hedge funds almost always specialize on merger arbitrage. One of our alums is a big deal in this market. I reached out to him about 2 weeks ago whether he could come and join us. He is actually traveling. Otherwise, I would have asked him to come in. He deals with actual trades. So I'm going to put the recorder on pause. It's about 7:47. So we will come back at exactly 15 minutes later, around 8:02. So I'm going to pause the recorder. Okay. So we have looked at the cash offer, which is the simplest, just by the target. We have looked at the stock offer, which is a little more complicated because it has the additional uncertainty of the price of the acquirer stock on the day the merger is completed. But there is another one, which is basically cash plus stock. That actually, as you can tell, is basically a hedge against the acquirer stock. All of this is actually negotiated between the acquirer and the target. But whenever there is a component which is cash plus the acquirer stock, you can immediately assume that the target is a little skeptical about the value of the acquirer stock. Now, I have actually included a Harvard Business Review article on stock versus cash. So here is, and I will not have time to go through that today, but hopefully we still have 2 more classes. And if time permits, I will actually explain the basic theory underlying which particular mode of payment the 2 parties will agree to. Now, from a target shareholder perspective, which is better, cash or stock?
You like cash. Cash is a sure thing.
Okay, I can understand that. Cash is your thing. Take the cash and get out. Now, when the acquirer wants to pay you by stock, there are 2 uncertainties. There is obvious uncertainty about the value of the stock. Now, the market almost always makes some assessment of the underlying value of the stock whenever the management is trying to use it, or let's say management is selling the stock. That is bad news, of course. But when the acquirer is paying you by stock, would you expect the stock to be overvalued or undervalued?
Over, I guess.
Undervalued.
Good question, Professor.
It's practically the buyer, so the acquirer needs to pay more, I think, than the market price typically.
I didn't quite follow what you meant by that, but I have heard both sides, higher and lower. Would you, meaning that, what, can you explain as to why do you think that the acquirer value, market management's perceived value of the stock is lower when they are trying to pay by stock?
I said high.
Lower. Huh?
Yeah, I said higher, so it's not me.
Okay, but somebody did say lower. Was that Carlos?
Yeah, it was me, but I meant to say overvalued. Yeah, it makes more sense.
Okay. That the stock is overvalued, and that's why they are actually trying to pay. See, if that is the perception, that explains why when there is a stock offer, the stock price of the acquirer drops, because this is an overvalued stock. But one of the other things that happens is in a stock offer, and I am allowing you time to read it. So next class, when you come back, you will be able to read it. When it happens is that when the target actually is negotiating, they know that they do not know, but they expect that the stock might actually be overvalued. So what happens is that if the stock price later on drops, then the target shares some of the loss. And they obviously do not like that. So in most of the stock deals, you will see that there is something called a collar, in the sense that if the stock price goes from the acquirer side, of course, they will want the stock price to be as low as possible on the day of the trade. So basically, the acquirer wants the stock price to be low, and the target wants the stock. So the deal might say that if the stock price goes below this, the target will not take it. On the other hand, the acquirer might say that if the stock price goes beyond this, we are not interested in the deal anymore. We'll pull out. That's a collar. But it's a very fascinating thing as to why there are more stock offers now than cash. So you should read that. But there is the large reason is information asymmetry, that there is information asymmetry between the target and the acquirer regarding the value of the acquirer if this is a stock offer. So you should read that. Now going back to the case. And let me share. So we are now in the cash stock deal, and I will only explain the numbers, but not go through the whole mechanics, because that will consume a tremendous amount of time. I will just explain the deal to you. So in addition to the above two basic types of transactions, companies may also structure the deal using a combination of the above mentioned financing methods. Remember, the reason to go from cash to cash plus stock is because of the information asymmetry about the value of the stock, that at least let us take a part of it in cash. For example, deal structures can involve cash plus stock. For example, consider company A announces an acquisition of company T for a cash stock deal and offers $20 in cash for 25% of T. For the remainder 75%, T shareholders would receive 0.5 shares of A's stock, and the deal is expected to close in 1 month. Company A trades at $40 per share, and company T trades at $15 per share pre-announcement. The only thing that I will show you is how to calculate the value of the offer, because there may be some confusion. Students always get a little confused with that one. So the exchange rate here is 0.5 shares of acquirer for 1 share of the target plus $20 for 25% of the value. So upon announcement, the acquirer shares drops to $35 per share, and target shares increase to $17. So let's look at the deal price. This is the model, which is why I thought I should explain that part of it. The W1 plus times C1 plus W2 times C2. Cash plus stock. W1 is the percentage of cash consideration. W2 is the percentage of stock consideration, 0.25 and 0.75. C1 is the value of cash consideration. C2 is the value of the stock consideration. And then I let the class look at this thing and see if everybody understands. So DP is the deal price. $25 is the cash offer. No, it was $20, I think. Yes. So 0.25, 25% times the cash offer is $20 plus 0.75 times the exchange rate times the value of a share, which was $35 per share, is 18.125. Then the gross spread is 18.125 minus the target price of 17, 1.125. This is the expected profit. Does anybody, I mean, from gross spread, it is pretty easy. Does anybody have any questions about this equation here? Hello?
No, it's very straightforward.
No question.
Okay, good. One thing that you should ask yourself is that because it is 0.5 shares of A for every T, the value that you are getting on that one is 17.5. 0.5 times 35, 17.5. On the cash, you are getting 20. One question I have for you is, why are you getting more on the cash side? Why is it that the company A is willing to pay you more on the cash component than the stock component? Think about that one as to, does it make intuitive sense to you? Because once I tell you the transaction rate, calculating this is very, very simple. That's not the issue. But does anybody have the intuition as to why the cash offer or the cash component is higher valued than the stock component?
It sweetens the deal.
That's a very good way of looking at it, because it is the hedge that, because there is uncertainty on the stock part, we are sweetening the deal by giving you a higher value actually on the cash side, but only for 25% of the value. That means that on the cash side, they are valuing the company T at $20. On the stock side, they are valuing it at 17.5. Everybody has to ask, does that make sense to us? Sweetening the deal is a definite purpose. There is no question about it. That if they haggle too much, they will say, okay, all right, fine. And I realize, Cliff, that the greater the uncertainty about the value of the acquirer stock, the higher is likelihood, the higher percentage of the cash component would be the higher percentage.
Mm-hmm.
They're cushioning the risk for you. So I hope everybody understands this equation. If you do, then I'm not going to go further down, because the mechanics of it is very similar to what we did before. And also you need to convince yourself that this does make intuitive sense to us. From an economic standpoint, I can understand why the cash component is valued higher than the stock component. Now, one of the things that I should tell you is that, remember that on the stock component, there is uncertainty that the value can be higher or the value can be lower also. But there is a substantial probability that the value can be higher. So that 17.5 that you see is actually sort of like an expected value.
Professor?
Yes.
On that previous question that you asked, does it mean that, if a company thinks that the stock is overpriced, it will prefer to use the stock?
Well, that's definitely one way of looking at it. When you say that, you're saying that if the target is skeptical that acquirer stock is overvalued, are they more likely to negotiate a deal like this? I would say yes.
Okay, thank you.
All right,
sorry,
folks.
maybe I missed something. On the formula, it says 25% times 20 plus 75% times 50% times 35. That's a bigger portion than the first. The second, so the C2, the stock value of stock consideration is higher than the value of the cash consideration.
In absolute terms, higher. But what I'm saying is that the value of A, sort of like, for example, you are getting $20 for the target stock, but only for 25% of it. I'm focusing on that part. And you are getting, when you are getting 75% uncertainty, I'm focusing on this part. That this part is worth 17.5, whereas this part is worth 20.
Understood. Thank you.
Mm-hmm. All right, folks. Now I'm going to get to the last thing, and this will not take too long. This is the actual case. These are both drug companies, and this was an actual merger. Time is given 1999. This is, in my view, of course, the best merger arbitrage case and the simplest merger arbitrage case in Harvard. There are other ones, but significantly more complicated, simply because of the terms of the deal. Because the more components there are, the more complicated is the deal. Now, here is where I would ask that class to actually focus more on the details of the case than the numbers. Because the numbers, after what we have gone through, is actually quite straightforward. But the details of the deal is what I think you should be focusing on. For example, of course, the first thing that they have described are what are these two companies, company background, Abbott, and here is Elza.
Professor, sorry for interrupting, but maybe just me, but it looks like this case is not included in a Harvard Business publishing course. Yeah, okay.
It is not, but I have actually posted it in the course material.
Okay, understand.
If you go to the material for session 4, you will see that this case is included. Okay, so reasons for the merger. These are the positives as to why this merger. So these are the sources of synergy. Very, very important. So what you are looking at is basically the contract or the agreement or the details of the agreement. Very important as to what are the sources of synergy here. Then what is the structure? So on June 21, 1999, the boards of directors of Abbott and Alza announced that they had signed a definitive agreement for Abbott's acquisition of Alza. According to the press release, Abbott would acquire all of the outstanding shares of Alza in a tax-free stock-for-stock merger valued using closing prices as of June 21. Abbott was 44,316 and Alza was 46,1/4 at approximately $73 billion. For each share of Alza stock, shareholders would receive fixed 1.2. Remember, it says fixed. Here is why it says fixed. The word fixed is very important here. Because remember that the basic source, the most important source of uncertainty in this particular case from the target shareholder's perspective is what would be the value of the acquirer stock. So sometimes the deal could be made that, okay, at the prevailing prices, we are going to go with an exchange rate of 1.2 shares of Abbott for every share of Alza. However, if the stock price of Abbott drops below this, we will increase the exchange rate ratio to 1.5. On the other hand, they will say, on the other hand, if the price of Abbott goes above these, exchange rate will be 1:1. That means the exchange rate itself could be flexible depending on the price of the acquirer stock on the day the merger is completed. So there are many different ways that you can actually structure the deal to minimize the risk associated with the value of the acquirer stock. All of this is negotiated. So, but in this particular case, it is fixed. So on the closing prices, so if you take the closing price of 44.316 times 1.2, you should get 53.03, which represented a premium of approximately 14.7, not very high. The transaction was subject to approval by ALSA's shareholders, regulatory agencies, and customary closing conditions. Abbott's board was not required to seek shareholder approval for an acquisition. Company is expected to close that merger by the end of 1999. This was in June, so about 6 months. Because these are drug companies, so there are significant, antitrust considerations here. Very important, what are the risks of merger? Now, you'd imagine that in this particular instance, there may be some risk with respect to the target as well as the acquirer, because more with the target than the acquirer, because number one, the acquirer ratio is fixed 1.2, so there is not much skepticism about that one. But for the target, notice that it is only 14.7. So there may be some uncertainty, but not a very big uncertainty. Or, the thing is that, so the valuation of the target is not too much off what the acquirer expects it to be. But there are some significant risks here. So you should really read this. And you will see that most of the risk is related to FDA approval. So here is the position. Now, the important thing to keep in mind is that the position is unique to the arbitrator, because these prices may not matter to the arbitrator at all. What matters to the arbitrator is the prices at which they actually get into the transaction. So that's what this is. So Green Circle Arbitrage Partners, this is a hedge fund, established a long-short investment in the Abbott-ALSA deal on June 23. So I don't remember which day it was, from June 21 to June 23. We can always find out. 2 days after the announcement. Essentially, the fund bought shares in ALSA and sold shares in Abbott to capture the risk arbitrage spread in the stock prices of ALSA and Abbott. Smith, excited by the merger's strategic implications, but as yet uncertain about some of the valuation and regulatory issues, antitrust, limiting the investment to only half of the fund's normal maximum 25 position, which is roughly $25 million is their normal. In this case, they did about 12.5. Green Circle's initial investment reflected an anticipated gross risk arbitrage spread of 4.0. And I will show you where that number is coming from. And potential annualized return on 19.3. All of these numbers is actually worked out. I'll take you there in a second. However, here is an important part that students often miss, that it says tracking the deal. See, what they're tracking here is the spread, because the spread is what is most important. And the spread will determine how much money they are going to be making. This 4.20 is sort of guaranteed because they have gone long and short. However, during the period that they are waiting, prices can fluctuate significantly, narrowing the spread and often increasing the spread. And the arbitrator closely watches that. So now there is one particular, so remember that the original spread was 4.20. On the day that he is actually writing the case, here is what his concern is. The decision. It was getting late, and Smith decided to call it a night. He realized, however, that he would need to make a decision regarding the fund's investment in the Abbott-ALSA deal. Why? Because Smith realized that the recent developments with respect to Abbott's FDA issue, I told you that there is an FDA issue all the time. additional risk into the buyer's fund's investment. Would the deal close? That's the only question he has. What would it take for that to happen? Now, this is his concern is what if the exit clause kicks in? Then the deal will close, or rather will fail, and he's exposed to the spread at that time. So he's extremely worried. Notice that his worry is about the stock price movements, but not caused by the economy, but caused by the FDA approval issue of the acquirer. That the deal was made with that particular FDA issue unsettled. And how that particular FDA issue settles will have an immediate impact on the price of Abbott and definitely on the ALZA shareholders. And that's what he's concerned about, that what if FDA approval fails and ALZA pulls the trade. Now, if ALZA pulls the trade, then he's exposed to the spread at that time. Smith checked the day's prices and saw that Abbott closed at 37.75, substantially below their price, while ALZA ended trading at 40.12. The spread had widened to 5.175. Now, think about it this way, that actually the spread of 5.175 is better for him than 4.20 because he's going to make more. However, he needs to know why that is, in the sense that why did the price of Abbott drop so much, and what if this continues? He thought about it. So the concern is not with the spread itself. Concern is why this happened, for number one. Number two, the underlying cause is the concern, that the FDA approval. Otherwise, this is not bad. He thought about the alternatives. He could unwind, meaning that he could just reverse the trade, unwind the fund's current position, and realize a loss. Now, I will ask the class to actually think about why there would be a loss. It's very easy. Take the two prices and reverse the trade, and you will be able to see that there is a loss. If somebody does that and shares it with me, I will be happy to actually share it with the rest of the class. That means that what he's saying is that if I actually close the position now, reverse the position on Abbott, meaning buy it back in the same ratio of 1.2, and then reverse the position of ALZA, that means sell it at these prices, then what would be my net? If he did this, what challenges would he face? Meaning that challenges, meaning that he will have to explain to his manager as to why he took the loss. How much could this cost? Once again, I want you to understand his concern is not just the spread widening, because if the deal closes, he is fine. So the real question is, how significant is the FDA approval issue, and will that affect the probability of the deal closing? Don't lose sight of that he is playing the risk and the probability of the deal closing. Would unwinding be premature at this point? Another alternative would be to adjust the investment to include protection or insurance against additional losses on the Abbott. Put options on ALZA maturing on 18/19/99 with a strike price of 40 could be obtained for $3.25. Why is he considering put options on ALZA? Obviously, because he's long on that. The short-term risk-free rate is 5.29%. How could the option? What he's asking is that if these options are actually fairly priced or not. Remember that the risk-free rate can have an effect on the price of the put options or at call options. How could these options be applied? How would this affect the annualized return? Of course, it will affect, because $3.25, that's pretty expensive. As a third alternative, this is even more interesting. If Smith believed that the deal still had a good probability. See, that's the whole point. His main concern is whether the deal will close. Because if the deal closes, then he might actually increase his position at the wider spread because he'll be making more. If he believes that the deal still had a good probability of closing, he could maintain the fund's existing position or even take advantage of the widened spread by increasing it. Increase the deal or the investment. What were the risks and potential returns associated with this? Pretty complicated situation for him. Smith needed to give his traders an order before tomorrow's open. A decisive decision would have to be made. Thank the rest of the night to sleep on it. That's exactly why these people do not sleep well at night when they are exposed to this arbitrage condition. Remember, none of this would be an issue on a cash offer. This is an issue on this one, not because of the spread widening, but because of the risk associated with the FDA approval. That if that does not go through, the deal will be off. And that's why you need to read the risk as to whether that was an exit clause or not. Now, I will now go through this part, which will not take us too long. Notice how much detail is provided. So the math is not the important one here. It is the intuition. Here is the calculation of potential annualized. $12.5 million is their investment. Date of investment is June 23, as you remember, 1.2 to 1. 43.5 was the was the stock price of Abbott. He's shorting it, and he's buying 260 shares of the target Alza at $48, and 312 is 260 times the 1.2, because that's the exchange ratio. Do not forget to adjust your short position by the exchange ratio. 50% is the long position, 50% on the short position. These are basically unnecessary complications because he's saying that he's going to borrow and lend and all that. So we'll see what happens. Interest rate is 6.2%. So let us look at the gross spread first, which is very easy. 43.5 times 1.2. That's what you are going to be receiving. Abbott shares, 2 Abbott shares, minus the 48 you pay for the target. This is the 4.20. That's the number they were referring to. That is the spread. Now remember, that is the spread for him. The spread could be different for somebody else. It all depends on what are the prices at which you trade. Now the gross spread value we received in the transaction is 43.50 times the 312 minus 48 times 200. This is what you bought. This is what you sold. So $1 million. However, then you have to adjust for the transaction cost. And that's what makes life a little difficult. So gross spread minus margin interest. That means that they are actually buying at 50% margin and shorting at 50% margin also. Remember, on a long side on the margin, you pay the interest. On the short side on the margin, you receive the interest. So on the long side, there is a minus here. On the short side, there is a plus. This 6.2% is actually the rate of interest times the 50% margin times this amount that you actually, that is the value of the target shares, plus 5.6% again is the interest you receive. Then times 13.572 plus all of this is annualization. And that gives you 1.287 because you make a little more on the short side because the money that you receive when you sell stays entirely with the broker, which is this, and you earn 5.6%, which is why there is a 50% here on the long side, but no 50% on the short side. So 1.287 potential return is of ROI is, this is your investment, 50% and 50%, 10.1% is the return. You annualize it, 19.3%. That's not too bad. 19.3% over a 6-month period of time. Actually, no, this is annualized. 10% on the 6 month is not terrible, but not that impressive either. But the most important, this calculation, there is a little bit of complication because of the transaction cost. Otherwise, it's very straightforward. But the biggest question here is this. So there are 3 choices. One choice is to get out. Check the loss and get out. Now you have to check and satisfy yourself that there is actually a loss here. If I were to reverse my position in Abbott and reverse my position in Abbott, you can check that. The other one is status quo, do nothing. Third one is increase your position. Each one of them will have to be explained to his manager. Very fascinating case, real life scenario, and it has all of the parts that you really need to pay attention to. What are the synergistic positive gains here? What are the sources of risk here? And the other most important thing is how much the prices are fluctuating. That's why all of this information given here is so critical. That prices are fluctuating tremendously over this period of time. Every single day he has to watch it and go to bed worrying what will happen tomorrow morning. And that is a very uncertain situation. Nothing could be more, and Cliff made the point that today was a big day in the market because of expected earnings announcement from NVIDIA. NVIDIA actually beat them on the estimates, big time. But it is NVIDIA which is down, and also the futures are down significantly also. So this market is very, very hard to fathom, very hard to fathom. And there is just so much uncertainty with respect to the Iran war. As you know, the war is basically status quo at this point of time. And that's very important, the market, because gas prices are still very high. But at the beginning of the day today, Treasury bill rates were actually lower. But I think it has shot up. So that is the uncertainty going into the summer. And the Fed chairman has been changed. So as I told you last class, do I expect the interest rates to be lowered a little bit? I would think so. I would think so. Now, Mr. Trump is much more business oriented. So that's what complicates it, in the sense that whenever he's thinking of the war, most of the presidents may not be thinking of the market. He does, and the compromise between the two is very, very. That's what he's trying to do, which is complicating it even more, because his focus is on the interest rates. So I'm pretty, I should not say pretty sure. What do I know? But I do expect there will be a reduction in interest rates in the next few months or so. But the next couple of months are going to be very, very, very challenging for the overall market, I think, because of all of the uncertainties that have been brought in. It's a very difficult situation for most investors. So I don't have anything more to add. Very fascinating. Remember, there are 2 things that I told you that you should check. One of which is definitely that stock and cash together. That example, you should go through that. I have covered most of what I think is vital. You should be able to cover the other steps. And also, somebody should check how much is Mr. Smith going to lose if he closes his positions at these prices today. There is no doubt that that exercise will be very helpful. Because remember, he bought Abbott. I'm sorry, he sold Abbott, so he has to buy it back. He bought ILZA, so he has to sell it. Just take the difference between the two prices and add them up. That will tell you what is his net profit or loss. Then, of course, you have to adjust by the number of shares, no doubt about that. But don't worry too much about the transaction cost. That's a part of life, so don't worry too much. Any questions, folks?
No question, Professor. I'm gonna have to go over the material, and then I might have some
No
questions.
question.
Okay, no problem. No problem.
Professor, question. I do have a question. I do apologize. So I'm going through, like, I feel like I'm catching up because there's so much material in a short period of time. So I'm still like going through options and stuff. So how important for the test purposes and everything, Vega, Delta, somebody has their mic on. Or it's looping in.
I missed the last part of it, Alexis. You need to repeat.
Say again, Professor?
Yes, go ahead. I didn't catch the last part of it. I heard how important is the options, and then I lost it.
Cliff, can you turn up the mic? I think it's like looping. The sound is looping in. Thank you. So the question was, how important for the test, the knowledge? So let's say, I'm just trying to go through. I'm like coding right now, trying to figure out how to do it the best way. So how important is the Vega, Delta? You just want us to have a knowledge? Do you want us to be to apply it like test wise? Is that a good question?
Well, here is, I mean, the apply thing. Remember, the options has several different parts to it, one of which is the fundamentals. Basically, what is a call, what is a short call, what is a long put, what is a short put. Then
Correct.
the applications are sort of like the protective put and the strategies. And I told you last class also that some of the strategies are definitely very, very widely applied, one of which is obviously the collar strategy. The other one is the long straddle, is more widely used than the short one. And the other ones, I think, if you look at the option trading strategies, and before the exam, I will highlight a few other. I am not going to be expecting you to look at more than three or four combinations of strategies on options. So that's one part of it. The other part, which I actually did not go through in this class because the students told me that, and I know that you have gone through this two-state option pricing model in, I think, Jaideep's class as well as Yakov's class. I remember Cliff telling me that you went through Yakov's class and where you actually did more than 2 periods. Now, in my exam, you will not be expected to do more than 2 periods. So that's on the valuation side. Obviously, put call parity is on the valuation side as well. A lot of different parts to the options. Now, one other thing that I think is interesting is, for example, particularly before the earnings announcement for companies like NVIDIA, there is a lot of options trading. And a lot of people actually look at the options trading to extract what we called implied volatility. And it's very, very difficult to actually, I mean, I agree. I mean, I don't know if that's what Cliff meant, but I actually expected after reading about NVIDIA today that, and I'm tracking some options that the market will respond positively. Far from that. Market did not respond positively. And actually the whole market responds. I mean, so you can hedge a lot of things with options. And that's why options are so important. So can you expect that I might actually ask you that this is the expected stock price movement. What type of option strategies would you consider? Yes. So that's what on the application side. Nothing beyond that. So if you really go through the cases we have gone through, obviously then, Mogen has applications for options as well with respect to you need to calculate the implied volatility and all. So there are a lot of parts to each of these cases, a lot of parts. Actually, the simpler one is the fixed income arbitrage, where you just look at the difference in yield of the two bonds, and then the rest of it is very simple calculation. So if you go through all of these things, then I think you should be in very good shape. And remember, each class we have something a substantive topic. So, like today's class also was a very substantive topic, which is very widely followed by many hedge fund managers, particularly. Most hedge funds always have a merger arbitrage desk. And so I feel that the material that we are going through is very, very substantive. And the last class also there is fairly complicated, interest rate swap, which is why I made this a group test, because the material is heavy, intense, and can be complicated, which is why I thought that it is better to have the students share the load, and you can decide amongst yourselves that I have question and that question, and do it that way. I will definitely be giving you more information as we get closer to the test. There is a review session 1 week before the test, and by that time I expect to know for sure what the test will look like. I do now, but I'm not absolutely sure because I change it every year. So that day you will have much more precise information, but I think the basic structure of the case is what I just described.
Got it. Will something, let's say hypothetically, include dividends in calculation of the options? Like
it all depends on whether the company pays dividends or not.
Say it again.
I said it all depends on whether the company pays dividends or not.
Oh,
like for example,
okay.
let's say I give you Google's options, okay? And if you are using the bar chart, which is the one I used, and put in Google, they will pick up all of the information for you anyways.
Got it.
They
Okay.
will, but you can always check by going to Yahoo, which reports the dividend yield. Yes.
Mm-hmm. Okay. Awesome.
So
Thank
that's
you.
the advantage. That's the advantage of using the bar chart calculator, that as soon as you put in the ticker symbol and then the characteristics of the options, it will give you all of the things immediately.
Got it.
Any other question, folks? All right. In that case, I will pause the recorder, or actually stop it.